Hey everyone, welcome to This Explainer. I am so thrilled you're here with us because today we are unpacking the complex but honestly utterly fascinating world of how governments decide who pays what on their property. Whether you're a homeowner, renting an apartment, or really just someone curious about the nuts and bolts of local economies, understanding property rating valuation is like getting the secret blueprint to how cities actually fund themselves. Okay, let's dive right into this.
So, here is our roadmap for today. We'll start by decoding market property value. Then we'll look at 3 property tax approaches, followed by exploring capital value systems. After that, we're understanding annual rental value, looking at the criteria for selecting bases, and finally, getting to the verdict in our ARV versus CIV showdown.
All right, Section 1, Decoding Market Property Value.
Okay, so before a government can even think about taxing a property, they have to figure out what it's actually worth, right? But what does value really mean in the eyes of the law? Well, notice how we have to separate value from the numbers we usually think of. Market value isn't just the literal price tag on a recent sale. Price is an observable transaction, sure, but market value is what we call a normative estimate. Basically, that means it's a theoretical, standardized estimation of what a property should exchange for under normal conditions. And actually, market value is not the same as cost either. Just because you spent a small fortune building or replacing a house doesn't mean the market is going to pay that amount for it. Market value is the absolute foundation that drives all rating systems, and it's completely independent of whatever your actual construction receipt says.
Moving on to Section 2, 3 Property Tax Approaches.
So now that we have our foundational definition of value, let's explore the main tools governments actually have in their toolkit. They generally rely on 3 broad approaches to establish a taxable base. First up, there's capital value, and this is based on the market sale price of the land and the improvements on it. Second is annual rental value, which doesn't look at the sale price at all, but instead looks at the property's rental income potential. And finally, there are non-value approaches, which might just use flat fees or charge by the square meter. These non-value methods are typically brought in where property markets are simply too thin or quiet to generate reliable sales or rental data.
Next up, Section 3, Exploring Capital Value Systems. Let's dive into the most widely used system globally. The primary method here is called Capital Improved Value, or CIV. By definition, CIV is the sum the land and its improvements might realize if offered for sale at arm's length. What makes CIV so incredibly popular is that it aligns really closely with the total distribution of wealth, Those with more valuable total assets end up paying more. It also heavily discourages landowners from just hoarding empty land for speculative purposes because the full value of the property is being taxed.
Now, here's where it gets kind of fascinating. There is a huge debate between capital improved value and unimproved capital value, or UCV. While CIV taxes both the land and the buildings sitting on it, UCV taxes only the raw land value. Proponents of UCV argue that taxing just the dirt actually encourages developers to build. Think about it. If an idle dirt lot carries the exact same tax burden as a fully developed apartment building next door, owners are highly motivated to actually put that land to productive use rather than just sitting on it waiting for prices to rise.
So, how do we actually calculate capital value in the real world? One major way is through income capitalization. This 4-step method requires the assessor to first estimate the property's net income stream, then select an appropriate capitalization rate or yield. Then, by dividing the net income by that cap rate, you arrive at the final assessable capital value. It is elegant math for sure, but there's a catch. It requires highly reliable market yield and income data to actually work accurately.
Contrast that with the contractor's test. Here, you estimate the reinstatement cost of improvements, adjust for depreciation and obsolescence, add the estimated land value separately, and sum it all up for the final capital value. This approach is literally a lifesaver when reliable income data just isn't available. In fact, this specific 4-step contractor's test method is exactly what is currently applied in practice in Ghana.
Let's shift gears to Section 4, Understanding Annual Rental Value.
This second major tool is super common across Commonwealth nations. Instead of looking at sale prices, this system is based entirely on rental income potential. We start with gross annual value, or GAV. Just think of a standard tenant-landlord relationship. GAV is the expected rent under the assumption that the landlord is the one bearing all the costs for repairs, insurance, and maintenance. Basically, if the roof springs a leak, the landlord is on the hook to pay for it.
But governments want to tax the net income, which brings us to net annual value, or NAV.
The absolute crucial point here is that NAV simply removes the landlord's obligations from that initial gross rental figure. So, by taking the gross annual value and subtracting statutorily determined deductions for those repairs and insurance, we find the true, refined taxable base.
Now, this system might sound super logical, but it has some distinct trade-offs. On the pro side, annual rental value is really simple for ratepayers to wrap their heads around. It requires no physical intrusion into your home or private income disclosures, and annual reviews are fairly easy. But on the con side, it can be highly regressive, meaning the tax burden falls a lot heavier on lower income populations. Even worse, it actually discourages property improvements. I mean, if you renovate your house, its rental value goes up and you get punished with a higher tax bill. Plus, it completely relies on a local area actually having an active, transparent rental market.
Which brings us to an incredibly important question. With so many methods on the table, capital, improved, unimproved, gross rental, net rental, how does a local government actually sit down and choose which system to use? Let's bridge this theoretical math into the real-world policy decisions that governments face every day.
That brings us to Section 5, Criteria for Selecting Bases.
When lawmakers are designing a tax system, they're guided by 4 specific dimensions that dictate the rules of the game. First is legislation. Quite simply, the legal framework dictates what basis can actually be applied in that region. Second is land tenure and market data. You just can't have a value-based rating system without a vibrant, transparent property market. Third is taxpayer perceptions. This is absolutely crucial. Public trust depends entirely on the perception of fairness. If citizens feel cheated or don't understand the system, they will reject it. And fourth are the economic issues.
Let's zoom in on those economic criteria, because they're essentially the ultimate balancing act of public finance. A chosen system needs revenue productivity. It has to provide a stable, predictable income for the government, even when the economy wobbles. It needs neutrality, meaning that tax shouldn't unintentionally manipulate private economic decisions. It requires simplicity, just to make mass valuations financially feasible. And finally, equity. The system must be fair, both horizontally, treating similar properties equally, and vertically, scaling proportionally with the owner's wealth and their actual ability to pay.
And finally, Section 6, the verdict, ARV versus CIV.
All right, it is time for the final heavyweight showdown between our 2 main property tax systems. Annual rental value is based on income flow, making it highly stable over time and much easier for mass valuation of similar properties. But it places a near-zero tax on vacant land, which heavily encourages speculation. Capital improved value, on the other hand, is based on the market sale price. It slocks a full tax on vacant land, stopping speculation in its tracks. CIV is definitely fairer and better exemplifies equity, but it comes with greater volatility and is incredibly data-hungry, making mass valuation expensive and complex. To bring this all back to reality for a second, we can look at Ghana's approach. As we touched on earlier, Ghana utilizes the contractor's test, which, remember, is a variant of the capital value system. Why? Well, because places with thin or less transparent rental markets simply don't have the vast amounts of homogeneous rental data needed to make an ARV system work. They have to rely on evaluating the reinstatement cost of improvements to bypass that lack of market data.
Okay, let's do a super quick recap of the whole shebang. We learned today that property rates stem from capital value, annual rental value, or non-value approaches. We saw how capital improved value taxes the whole property, while unimproved focuses just on the dirt. We discovered that net annual value is really just gross annual value minus landlord maintenance costs. We reviewed the 4 dimensions of tax selection: legislation, market data, perception, and economics. And we saw the final trade-off: ARV is simpler but can be regressive, while CIV is highly equitable but requires rich, expensive data.
I want to leave you with a quick thought experiment. These aren't just abstract formulas in a textbook. They literally dictate the financial reality of the neighborhoods we live in. If your local government switched from an annual rental value system to a capital improved value system tomorrow, who would actually end up paying more on your street? The person with the beautifully renovated house, or the person sitting on the empty, overgrown lot next door? Keep that in mind the next time you open your mail and look at your tax bill. Thank you so much for joining me for this explainer, and as always, keep learning.